I am exhausted of hearing about AI. Is this the bubble? Are we going into the next Great Depression? Or is this the beginning of the next supercycle? Who knows, right? Every other day there's a new bullish or bearish narrative going on. It's like, oh, S&P 500 is going to 10,000. Actually, no, it's going to go to 5,000. We hear that right now there's a lot of circular spending going on. Nvidia is selling chips to Microsoft. Microsoft is selling their data center space and their cloud network to OpenAI. And then God knows what's going on with OpenAI because they're not a public company. So that's sketch, right? Oh, but wait, Google's actually just brought in $100 billion revenue, $100 billion in revenue in a record quarter. So then it's like, well, maybe these companies have a lot of money to spend. It's okay because they're using a lot of their cash flows to spend on AI. But then we see that Oracle may now be using debt to finance their AI spend, and that seems bearish. But just whenever we all turn bearish, then it's like, but there's a trade war going on and that could actually be coming to an end. And then China opens up, they start buying Nvidia chips, and that would drive Nvidia stock higher. The market's definitely not pricing that in yet. And then Apple's phones, the iPhone could start being sold more to the Chinese consumer. That's not priced into the market. So now we flip back to being bullish again. S&P 500 to 10,000, baby. Oh my God. I mean, that's just the narrative for this week. Who knows what it'll be next week? And ultimately, I'm just so tired of hearing about AI. AI this, AI that. It's a bubble. It's not a bubble. Oh my gosh. I'm so tired about it. I'm so tired. Because it's like, does it really even matter? I'm a dollar cost average investor, buy and hold forever. I'm 29 years old. I really think that anyone under the age of 50, they're just going to keep doing the same thing, automating their 401ks, moving money over to the brokerage accounts, and continue buying index funds. So does it really matter if we're in a bubble or not? But this whole AI argument has brought one question to the front of my mind, and that is, am I comfortable with the current asset allocation that I have in my portfolio? And it's really got me thinking. I think a lot of investors haven't been able to articulate that question to themselves. Am I too overexposed to technology names? Do I need to be making changes in my portfolio if the worst were to come? So taking a look at my own portfolio, right now I have 45% of my portfolio in information technology. It's $332,000. And then I have 54.9%, about 55%, in broad market diversified ETFs, specifically like Vanguard's VOO and their total stock market ETF, also VTI. So when I look at this, I think, am I comfortable having 45% of my portfolio in technology? This reminds me of a recent passage I just saw from John Bogle. I was reading this Common Sense Investing book. I think that was what it was called. And Bogle said, half of the time I worry that I have too much in equities and the other half that I don't have enough. And he's referring to whenever the stock market's going up, he feels like he has too much in bonds, and then whenever the stock market's going down, he feels like he has too much in stocks and he wish he had more in bonds. Now, again, I'm only 29, and I think for anybody who's in their 20s or 30s, probably even 40s, it doesn't make sense to have bonds in your portfolio. But I am thinking about this as like the S&P 500, the total stock market indexes are kind of like my bond section of my portfolio. And then concentrated ETFs into information technology ETFs, the one I'm specifically buying, VGT, that's kind of like my stocks to his stocks. That's my risk, my additional risk in my portfolio. And whenever the stock market's going up, it's like I want to have more tech exposure. But if the stock market's going down, tech's getting crushed. Do I feel comfortable having 45% of my portfolio in here? So what's the worst that could realistically happen? That's what I'm asking myself these days. And I like to look back to the dot-com bubble. I mean, I don't think we're going to go through the Great Depression, but let's go back to the dot-com bubble. And we can take a look at QQQ. At the top of the dot-com bubble in 2000, the QQQ ended up falling over the course of 2 years, down 83%. It didn't break even again for another 17 years until 2017. That's nuts. 17 years it took for tech, specifically the tech sector, QQQ, to break even. But here's the paradox of it all. despite the crash, despite the flatness, despite the pain, looking at the S&P 500 SPY ETF compared to QQQ, going back to 1999 to 2025, the tech sector still outperformed the S&P 500 by 667%. So it's like there was a lot of pain, a lot of pain in the tech sector. But if you held on for the long term, you still made out like a bandit over the course of 26 years now. And that's because I think tech is a long-term story. It's not a AI story. It's not a Mag 7 story. It is a long-term story of, will technology be leading the stock market, be leading the economy for the next 10, 20, or 30 years? And I tell myself, yes, that's why I'm overweight tech stocks. Do I feel comfortable holding 45% of my ETF or my portfolio into VGT? Yeah, because I'm not thinking for the next 10 months, I'm thinking for the next 10 years. I'm thinking that, look, I'm 29 years old. Even if we were to go into a 17-year period of the market falling down and then taking 17 years to recover, one, I'm a dollar cost average machine. I want to keep buying all the way down and then all the way through the next 17 years. So by the time we get back to break even, I'm going to be freaking racking it up. That's compound interest working at its finest. I'm going to be stacking. And anyone else that's out there buying and holding and dollar cost averaging, you're going to make out like a bandit too. So it's like, really, if the market could drop 83%, I would consider that a blessing from God. Now, I have to be honest with myself. It is going to hurt in the short term. I actually was buying VGT information technology stocks going back to 2021, whenever there was the everything bubble. There were the NFTs, there were the SPACs, there was the metaverse, there were the meme stocks, and the market got pretty frothy. And then it ended up selling off by 37%. But that whole entire drop on the way down, I just kept buying S&P 500 ETFs, total market ETFs, and information technology ETFs, which has got me to where my portfolio is now, the $735,000, 45% information technology, and then the other 55% being the S&P and total market ETFs. And because the market sold off, because it had that 2-year being a bearish period, I was able to accumulate a lot of stocks, and my wealth was built a lot faster than I thought it possibly could be. So it's like there's a lot of noise in the market right now. And I'm thinking that I didn't buy technology stocks. I didn't start buying technology stocks in 2021 because of AI. So why would I sell them now because of AI? I've been buying technology stocks because I've been waiting for the market, waiting for these tech companies to do something big. And this something has now just turned out to be AI. But I'm not going to sell now just because they did something big, because I believe they're going to continue doing big things. That's the whole thing. That's the whole idea, the whole point, the whole reason of long-term investing is you can't predict what's going to happen, but you suspect there will be something big. And I suspect that tech stocks are going to continue to outperform. They may go in a nasty drawdown. They may have a bear period for 5-10 years. I don't know, maybe it could be 17 years, but in 17 years, I'll only be 46 years old. So I'm a young investor, I'm dollar cost averaging, I'm thinking for the long term. But I think this is a good time for you to also be thinking to yourself, if the worst comes to happen, are you comfortable with your current allocation? Do you like the portfolio you have? Maybe you have too much Nvidia, maybe you're holding too much individual stocks, maybe you're holding too much crypto, maybe you're holding too much QQQ or VGT. So it's always a good thing just to be reassessing how you feel right now before things get crazy. And if you're comfortable with the risk, then keep on doing what you're doing. And if you're not, then, maybe you can revert back to going to holding more S&P 500 ETFs, or I don't know, if you're super conservative, maybe even get on that bond bandwagon. But if you like this video, be sure to hit that like button, hit that subscribe button. I'm just trying to make sense of all this AI noise out there and how it actually affects us as normal investors. I don't think it does, but that's my take.